Okay, one of my favourite topics tonight. I was just having an interview with Bull and Bear magazine in the States, actually, about 6 o'clock. And my 80-20 rule was something they were quite interested in talking about. So it's not a unique theory. Again, it's not something that is not known, but it is something personal to me. Obviously I know a lot of things, I read a lot of things, but this is something just purely out of my own experience and my own trading. And it's something that hasn't just really kind of come about from purely my own experience. It's from looking at other people and other traders and trying to figure out what makes them tick. It really came from a couple of conversations I had with some quant traders, an actual rocket scientist, and he couldn't just deal with the emotions of new data coming into the market. He had to be able to program it out, and I was telling him that it just isn't possible, and that's the wrong way of looking at things. You need to look at new data and events as an opportunity. Some of the biggest amounts of money I've ever made have been off the back of news and data. So for me, it's invaluable. It gives you that important structure around your trading, day, week, and month. If you know there's good data out, like Nonfarm Payrolls, you don't have to waste your time trading that morning. So I think for me, the 80-20 rule is something you have to kind of take a step back and think about how other people approach the markets and know that you need that balance in order to have the complete, full style of trading. For a start, as always, spread betting and CFD trading carry highly risk or capital. Resulted losses that exceed your initial deposit. It might be suitable for everyone, so please ensure you fully understand the risks involved. The information can be provided here under no circumstances are considered an offer or solicitation to invest. Nothing here should be considered investment advice. The information provided is basically accurate. The data is produced. Again, education only. Content of the webinar is posted with the moderator, not intro.com. The content does not constitute financial investment or tax advice. Intro.com will not accept any liability for the content that comes made during the session. So, the 80-20 rule. We all know that markets trend, and this is one of the cornerstones of trading. But why and how the markets move and trend is another thing. Okay, the whole point of my 80-20 rule is to understand where we're right now and what's dictating the market movement. Many technical traders believe that they can fade out fundamental news. And again, I always ask the question, the reason why you would do this. Okay, it's an opportunity. Again, I look forward to the data. I look forward to things coming out and being released to the market. I look forward to earnings season. I like hearing bits of news that come over the wires and being instantly be able to interpret how they should affect the markets. That, to me, is understanding trading. You can't just bury your head in the books and look for the perfect technical setup. It doesn't really exist. Again, it's always going to be dependent on what the market's doing. And for me, I really enjoy the fundamental side and showing how it speeds up the technical analysis. It speeds up how the market interacts with Bollinger Bands, with support and resistance levels, bob levels. Instead of things bouncing, when you have a strong bit of information, levels don't act as support and resistance. They act as a target for them to break through and go to the next level. So again, when the markets are heavily trending and when they're driven by fundamental news, I think it's a lot more understandable for me because your levels are hit a lot quicker, and instead of having to wait that slow grind for a market to tell you it's right, you get on side that little bit quicker, and then you can ride the technicals a little bit longer, and it just gives you that bit of emphasis, that bit of urgency. So I really enjoy when the markets are being pushed in a fundamental manner. So I think really the whole point is that you have to understand that all the things we do have to be married up. That, if you're trading the market, which is made up of other people, then you have to understand that they're going to have a bias. They're going to have a sentiment. They're going to listen to last night's news. They're going to have read the FT. Again, all these things take a little bit more time to filter through. So the 80-20 rule is not an exact one. It's not like I came up with an exact, 80-20%. That's the way it has to be. There's obviously interpretation in all these things. But I think that the 80-20 type rule really, for me, shows how very, very important the technical side of trading is. But then knowing that you have to keep that one eye on the fundamental sentiment. So when the markets are moving due to new pieces of data and new things that are announced, again, I don't think that the market takes on a different style, or it doesn't really take on a different meaning. When you're trading off the back of fundamental news, you're still always trading technically, but as I said, you're just trading that a little bit quicker, and you have to understand that levels will be a little bit more susceptible to being tested and to being broke, and then the pullback to be a lot quicker and a lot sharper, so you have to be a lot more accurate. So, for instance, if we're trading non-farm payroll, it's expected 100,000 and comes out 200,000. Gold is probably going to drop, a point very quickly. But you have to be very precise to know when to get out for profit or to get back in to buy the lows for the inevitable bounce. With fundamental news, you very only rarely get one bite of the cherry. Okay, on one bite to get them perfect levels. Now we've seen that when we're trading very big events like non-farm payrolls and we're trading that fundamentally. Okay, what we wait for the market to do is print that first 5-minute candle, perhaps do a Fibonacci, then look for the market to continue or reverse. There's only really the non-farm payroll where you can do that because it is so heavily traded and again it is so very, very volatile. But the rest of things, like big news events, you generally only get one chance to get that good entry point. You can still buy and sell if the market's moving aggressively up or down, but you have to be, fairly quick to get on the back of these moves, because if you don't, the opportunity's gone, and you end up just buying into, when everyone else is selling to get out of the positions, or selling when everyone else is buying to get out, and that's where the kind of whipsaw effect comes in. So if you have to hear something, you've got to analyze it very, very quickly, have an understanding what it means to you, and have an understanding what it means to the rest of the market participants, and then trade accordingly. So how do we identify when the market is moving in a fundamental manner? Well, again, it's generally when the candle sizes are out of the ordinary. We're trading more than the ATR, the average true range or trading range. And the best way to understand when the markets are moving fundamentally is that you'll hear it. You'll hear it on the squawks. It'll be the same kind of times during the day. And again, it's all in your economic calendar. So it doesn't matter if you look at the economic calendar from Intertrader, from FX Street, from Bloomberg, Reuters. All these things are scheduled. There's no surprise. You should never be surprised that the market's moving and go, oh, of course it's moving. It's non-farm payroll. Again, that's all part of the preparation and planning that we talk about in the Trade for Life course. The whole part, the whole part and parcel of trading, the fundamental side is understanding that these things are scheduled. That generally, the data comes out at 1:30 UK time, and that's for most major events. We know that most major events are from the US that will affect all markets. So we focus in on what the market's doing. We know we're looking for growth figures. So we should be straight away when the month begins, looking through the calendar, US GDP, trading that, US consumer sentiment, trading that, non-farm payrolls, of course, jobless that we saw today, Michigan, Philly Fed, all these things. I've just rhymed off 4 or 5 different events, which means you've got 4 or 5 afternoon of a month trading taken care of straight away. Okay, there might even be 4 or 5 days. So a quarter of your trading month can be attributed down to this fundamental data. And again, as we know, you can buy and sell prior to the release. You can put positions on, a day in advance or hours in advance if you've got a good feeling. Or again, we can build positions after the event and trade the aftermath. Or again, we can use our orders in order to get filled on the extremes and take them relatively quick trades. So I don't think there's any excuse for not understanding when the fundamental data comes out. And you have to treat each one as an individual piece of information. If you pick 5 to 8 figures a month that you want to trade, maybe you focus in on like the ZEW for trading the DAX once a month. Okay, you might make money 3 times a month out of it, but that's an opportunity. That's, again, you've got a figure, you've got a range, you've got an idea what a good or bad figure will do to the DAX, and you trade it. So check. I would take 3 good trades out of 12 all day long, because these are the ones where you can put good size on. If you're prepared for it, you've done your research, you know what it's going to do to the market, you know what your technical levels are, then instead of trading 1 lot, you're trading 5 lots, 10 lots. You're getting some good value out of that data. And again, if you don't trade it, you've not lost anything. Maybe you then trade the aftermath. Maybe then trade, again, counter to what the figure was. Doesn't really matter, but you're prepared for that piece of information and you're trading around it. So as I said, I trade 2 events every month on Intertrader. We did one this afternoon, the jobless, made some money in the euro dollar. Okay, I wouldn't have traded the euro dollar without that piece of data. Okay, we only made like 20 ticks, but doesn't matter. That's 20 ticks I wouldn't have got any other way. And again, if you build your structure around taking money out of the markets from your technical trades and then balancing it with the 5 to 8 maybe live trading kind of fundamentals every month, then you've got a nice balance. So schedule releases are very easy to understand. All this information is always free, and companies almost go out the way to provide this information now. You do have to be aware of the time changes. You have to be aware of the difference in between BST, GMT, and the time frames in New York. But I mean, come on, guys, it's not that difficult, is it? We know that generally it's 1:30 in the afternoon in summertime, and normal time it's 12:30. And that's a good time. We're all up, we're all awake, we're all ready for the markets, and it's a good, hour before the US Open. So it's absolutely great for us as UK traders to be able to get on the back of things and then ride them into the US Open. So when you get and click on the InterTrader, for instance, calendar, and you get something like non-farm payrolls on, then you have to understand what the data means. So non-farm payroll, we only really go off the headline when I'm trading, but it is made up of other constituents. So we have an unemployment rate. So unemployment rate, each point change is quite significant. So we have the main headline figure. So the consensus here is 85,000, but the range is 155 to 240. As I said, I've been trading non-farm payrolls for over a decade, called it right twice, and didn't really make that much money. So it doesn't really matter what the, if you're right or wrong in your prediction. That's not how you make money. It's reacting to the market afterwards. So we saw the prior release, 169, consensus 185. So we'd be saying realistically, anything below 155 is probably very negative for the market. So we'd sell the S&P, for instance. Anything above 200,000, 215,000 is probably a good buy. Okay, but 240 on the high side, yeah, that's a definite buy. So you get the unemployment rate, average hourly earnings, and the change in that doesn't really affect the market, to be honest. And the average work week doesn't really affect them either. Private payrolls can be interesting if it is out of line. And the secondary wave you generally see on the non-farm payroll is you get any revisions. So when you get this non-farm payroll, this prior one will be revised, okay, because it's obviously a month later. So, 169 could be revised up or down. So it's very interesting that we saw the 288 non-farm payrolls previously, and that wasn't really revised at all. And again, what was very interesting, when the non-farm payrolls was quite low out of the ordinary about 4 or 5 months ago, and all the market analysts put it down to the weather conditions and the snow. But then the revision didn't come in really unchanged at all. So that was actual real figure. The non-farm payroll was just down. It was just a bad non-farm payrolls. So that's something else to look out for that people will be keeping an eye on. So again, you have to understand the data you're trading. So the nuances that this non-farm payroll has with its revisions, the private payroll, won't be the same as other data. There'll be other things you'll have to explore with the ZEW or with the consumer confidence or with the Philly Fed. Okay, but they're all good ways of trading data. Jobless claims today, it's a little bit different because it's a high sell. So the higher the claims, the worse it is. So I think it was 209 expected today, and it was 217. So not massively out of line, but enough to kind of send the markets eventually ticking down. As I explained, we were trading very, very negatively in the hourly setup on the S&P. We're right below that 423.6 Fibonacci level, and once we started using that as resistance, the market sold off. So it's something to remind yourself that if you've got a fairly bearish technical view, then you have some bad bearish news. Well, what's the outcome going to be? The chance is you're going to short into the market and make some money. So that's what it's all about. So schedule releases again, and this whole fundamental side, I always really bring this home to people when we're trading any live events, is you have to understand what type of economic cycle we're in, rather in that growth cycle or inflation. 5-6 years ago, it was all about Jean-Claude Trichet out of the ECB, price stability. I never thought I'd say I've missed that man, but I do. At least you know where you stood with Trichet. Mark Carney's a bit of a joke. Not Mark Carney, sorry. Mario Draghi's a bit of a joke. I just don't have any faith in what he says at all. He's like a salesman. He's back into his Goldman Sachs role. He's trying to prove to world banks, to the wider economy, that no matter what happens, they can fix the Eurozone. It's fundamentally broken. You can't. And he's not the man to do it. There's not enough money. Germany's not got enough money to keep this going. Again, all the money was spent in infrastructure. If you drive in Spain, Portugal, the roads are amazing, but there's no one on it. Trouble is, when you saw that massive growth from second homes, in tourism, that's what the infrastructure was meant for. But it just isn't there. They have no real industry of their own to support that infrastructure or to bring that growth. So it's all built on false promises, to be honest. So really what we're trying to understand is, when we're talking about economic figures and data, what it means to the market, is what the policy makers are looking at, what the traders are looking at, and that's growth. So right now, inflation doesn't really matter if it's above target. We're keeping interest rates low to stimulate growth. But all the growth we've seen has come from consumer spending, from personal personal income. That's not what we tried to do. We recapitalised the banks with taxpayers' money in order to allow them to lend to small businesses and create jobs. What we've done is just carried on having an increase in price houses, increasing, consumer debt and borrowing, and that's how we're seeing these growth figures. Unsustainable. Not going to happen. But that's what the market's focusing on. When the interest rates finally do rise, and we see whatever effect that will have on the world, we'll go back to inflationary figures. Not to say the growth won't be in vogue anymore. We're still very, very interested in the growth. But when interest rates start to go up, we'll figure that inflation will have to be a target once more. So we'll look at the CPI and PPI. Again, things that are going to have an effect on inflation, and something that will change the policymakers' decisions. Because again, a lot of people are seeing the cost of living squeeze, real wages are not rising, and inflation, again, is why petrol's more expensive, why goods are more expensive, and all these things, again, will have to be controlled at some point. We can't just keep interest rates low and expect it to fix the economy. It hasn't done right now, has it? As I've just explained, the growth is not coming from the right sectors of the economy. So interesting. But again, understanding if we're looking at growth figures or inflation is very important because it's going to save you time. It's going to save you a lot of hassle as well. There's no point keep turning up for the CPI and PPI figures if no one's trading them. No one's trading them, the markets don't move, and then you end up getting in positions you don't want. So the non-farm payroll is, again, the biggest figure out there. And this is, again, just another way of illustrating the things that I teach live. So the non-farm payroll was expected 185, and in this example, it came at 148, so less than expected. Okay, so that is something that we know is going to affect the markets. So 1 second, let me just get the pointer on. So in normal trading conditions, this is bad news. Okay, so that would send the S&P down. So low non-farm payroll, market goes down. But again, you have to think of the timing. You have to think of what was happening back then. This is last October's non-farm payroll. This was very much when quantitative easing was still the topic of the day. So bad news actually sent the non-farm payroll up. So bad non-farm payroll, markets should sell down. Okay, so the S&P should go down. However, we see this, that the market actually bids up and spikes up quite dramatically on the back of the assumption that a bad non-farm payroll will mean that A, quantitative easing won't be tapered, or there might be more quantitative easing to stimulate the economy. So bad news, again, in that economic term and back in October, bad news was actually good news. I know, crazy. And that's why it's so important that you understand the market sentiment and what's happening with the policymakers and the traders out there. Because if you're getting bad news that's supporting what the policymakers are doing, and that is quantitative easing, that means, if anything, quantitative easing won't stop or might be increased. Therefore, more free money, more opportunity to buy the market. So once we see quantitative easing finally out the markets, we should return to some sort of normal trading conditions. So it's very, very difficult for traders, especially inexperienced traders, to trade the non-farm payroll. Because a bad non-farm payroll, you sell it. You sell the S&P. But in this scenario, we probably go up about, 150, 200 ticks, which, you can't have any reasonable risk reward on, and you would lose money. So again, it's understanding the market sentiment, understanding the economic cycle, and getting to grips with what that data is going to do to the traders in the market, because they will make it move, not to what you perceive the market should do. Okay, there's no prizes for being right in trading, as in saying, well, non-farm payroll, less than expected, I'll sell it, because that's what the market should do. If it rallies 2 points and you're the wrong side of it, you're wrong. Okay, doesn't matter if you interpret it right. Doesn't matter if you're doing the right thing. If the market's not doing what you expect, then the market's more powerful than you. So you get out and you buy it, or you stay out. It's as simple as that. What you don't do is hold on to a bad position when the market is aggressively going up and you're saying, well, it has to come down eventually. Markets don't have to do anything. It's all about timing. Okay, well, it gets to these high points and comes back down. So if you want to be a brave trader and hold on to all that risk and come down and scratch, or even see if the market goes down, that's fine. But in this blue box here, if the market's going up on bad data and you're selling it, you're wrong. So you just get out and wait till it starts doing what you understand. Don't try and force the market to do something it doesn't want to do. Trading, we're all generally right in trading. I could pick a chart up in the morning, say that market's going up, that market's going down, but I can sell it all the way up and lose money, or I can I can buy it all the way up and lose money, or sell it all the way down and lose money. There we go. Just because you've been right doesn't mean you're right at the right time. Trading's critical because it's all about timing, and that's why it's so frustrating that you can still lose money when you have the right opinion. So it's all about timing and being in the right position at the right time. So the importance of the 80-20 rule is that the 80-20 technical is so important because it gives that balance. If you're just 100% fundamental, then you're going to lose sight of the technicals. You're not going to have a rounded view. If you're all about the technicals and you can fade out and discount all the fundamental news, then it's limiting you. It's limiting your trading, and it's taking opportunities away from you. So it's just like anything I always teach in trading. You have to be rounded. Understand the market as an expectation, that the current market trend is based on a sentiment, and understand what that sentiment does. And that last non-farm payroll example was just to go to prove what I'm saying, that how can a non-farm payroll go up on bad data? Well, because the market was expecting something else. The market was expecting the fact of quantitative easing not being tapered and sticking around was actually more powerful than a bad non-farm payroll. So again, it goes to show you have to understand that sentiment when you're putting your trades on at all times. So there's definite crossover, okay, in all these things. And the fundamental side of trading has a tendency to catch people off guard when you see the markets overextended. That means people have got the wrong view at the wrong time. So then we're going to see the more aggressive directional pullbacks. And that's when things like Fibonacci come into play, okay? As I keep saying, if you want to see what the data is doing, okay, and what the market expectations are from a technical standpoint, then Fibonacci for me is the best way to look at this. So the 80-20 is, again, it's a long-term view of a well-functioning market. You're going to get these days that just don't make sense. You're going to get these hourly candles that don't make sense. You're going to get things that just catch you off guard. But when we're talking about trading, we're talking about the longer term. So it's a marathon, not a sprint. You're bigger than one trade. You're bigger than one day. You should have to be bigger and more robust than 1 month of trading to survive in trading. So again, it's all about understanding the bigger picture. The fact that something is moving in one direction very, very quickly, and it traces very little due to the market conditions, then these overextended markets, again, are going to catch people out. So if a piece of fundamental data comes out and the market moves 50 ticks in a straight line, yeah, if you're selling the market, you're going to be caught offside. If the market then only retraces 10 ticks, okay, for some profit, and then goes up another 50 ticks, then people are 100 ticks offside, okay, and then people all the way up are going to be offside. So anything that moves quickly and in one direction is going to catch people on the wrong side. It just happens. That's just the way it is. So the tools you want to do to understand when people are caught on the wrong side and to understand how you can benefit from these overextended moves, again, are things like Fibonacci. That will give you an understanding. The RSI, the Bollinger Bands, the demarker is always a good one. I really like that. So what we're looking for is that when new data hits the market, then people are going to be right, people are going to be wrong, new traders are going to enter the market, existing traders are going to exit the market. So you will get that initial volatility. So what we see is the market gets the data, so we quickly, take a positive view of what's been released. So what we do is we look for that 50% Fibonacci. So in hindsight, what we can do is from here to here, yeah, what I would do is a Fibonacci. Okay, because these are small time frame candles, like maybe the 5 minutes. Draw a Fibonacci from the low to the high, and that would mean that the Fibonacci level 50% would be here. So if we close above that and don't get back into this range, then there's more bulls than bears, and that will lead to this consolidation and the market to move higher. So in fact, what we've done is do a Fibonacci from the low point to the absolute high, and the Fibonacci states that 80% of the time, once you've found an overextended move, the market will retrace to 50%. So what we find is our 50% level here. So instead of buying, above the 50% here and letting that break, we can wait for the absolute high in the market to be found, because we know it is, because the market's closed here. So we do a Fibonacci from here to here. Then our target is the 50%. So 1, 2, 3 candles later, we're back to that 50%. So that's another way we could trade it on the way up from the fib, of a break, or just buy into the data, or we can wait for the absolute high to be found and know that 80% of the time an overextended move in this scenario will retrace to 50%, wait for 3 candles, and you've made your money. Okay, it doesn't get a lot more simple than this. And when you apply this methodology and you apply this technical overview of fundamental moves, you're gonna get that real benefit from it. So if you take a look at the initial move, the 3 green candles, then you're going to see that we don't retrace back into that 50%. So again, that's the fib from here to here, as I explained in this part here. So the market again, 1, 2, 3 candles up. Yeah, we find support on that 23.6, and as I've said to you, the 50% comes a pivot. So if we break down and close below that, we generally retrace the move and then some more. But if we close above the 50%, as we do 1, 2, 3 times, then the market finds a new high. What was resistance becomes support, and the market moves up. And then when you see the break of this red area here, and the market then spikes up pretty much the same distance as it started. So again, all you have to do is wait for that first 5-minute candle to print after any big news event. Do your Fibonacci, or again, we could do the Fibonacci on here, and that would still let you get long. But because again, we see the fake out, but it closes above what a 50% of this candle would be. But it's just trying to find the overextended move and identifying what a stretch is. And what I would say an overextended move is just a number of candles with big solid bodies that move in one direction. So where you pick your Fibonacci to and from is down to you. But realistically, we see 1, 2, 3 nice big candles. So that's enough for me to say, right, well, if I draw a Fibonacci from here to here, if we don't get to that 50% and don't get back into the range of them 3 candles, the market has to make a new high. Yeah, and then you have all your other Fibonacci targets that we put from here to here on. Again, it's one of these things, it's looking for what the market's done already and what it's telling you it can do in the future. So it's cast iron. When you draw a Fibonacci from here to here, the rules are cast iron. If we get to the 50%, okay, then we don't trade. It doesn't give us an exact point to buy. The market could go down to here and you buy, go down to here and you buy, or you can wait for it to break here. So it's entirely up to you where you get in. But if we don't get back to that 50%, you've got a good opportunity to buy at some point before we break and make a new high. It might be 1 tick, 2 ticks, 10 ticks, 100 ticks. That's for you to decide. But once you understand the market's going higher, it's not hard then to get into the market and make some profit. So remember, there are different phases to look at. So the initial buy. So although the Nonfarm Payroll was poor and the fundamentals should have sent the market down, the whole point of quantitative easing coming into the market or not being tapered is stronger sentiment than the technicals. Okay, so the technicals don't hold the market to be, levels of support. The support levels are then break, bob levels. So we have that phase 2 in the red area where the market consolidates and maybe people start thinking, well, bad non-farm payroll, we've already gone up. Perhaps the market should come down now. Then you've got people taking profit, and then the overriding fundamentals kick in and say, no, okay, they tie in with the technicals. We've not got back into 50% of this spike up. So therefore, the more buyers and sellers in the market, fundamentals are still pretty strong, as in that, yes, we're not going to taper quantitative easing. Everyone's decided that. Market then breaks and we go higher. Yeah. And that phase 4, yeah, well, that phase 3 is the overextension. Okay. So we see the initial move quite strong, the overextension, because this is all people getting out now. All these people going short here saying, well, bad non-farm payroll has to go down. Wrong. Sentiment takes it over and go all the way up. Then we have some sort of retracement or correction. As I said, 80% of the time, a strong directional move will retrace to 50%. So, as we see, the market hits the highs. We know it's a high because we closed below it. 1, 2, 3, back at the 50%. So you've got 2 solid ways of trading fundamental data there from a technical standpoint, taking very little risk. Yeah, very little risk in here to go offside, big upside. Sell when we get back into the green candle bodies, very little upside risk, good profit target. Simple as that. So again, to enhance the chart and to add other oscillators in, I mentioned to get a clearer reversal signal, use things like RSI. Okay, RSI at this point on this 5-minute chart was at 90.78. Okay, 70 is considered overbought. So when you get to 90 and above, the market's going to have to come down at some point. The marker is at 92. Same parameters as RSI. 30 is a bull reversal, 70 is a bear reversal. So 92 and 90.78 means at some point this market's going to reverse. So that's tying in other oscillators to give you a view. So when we hit this high point, it doesn't matter, you don't have to sell at the high point, you don't have to be perfect entry. All you have to do is sell at any point, yeah, when the market turns red in these candles and follow the RSI and D marker down. Okay, it sounds simple, doesn't it? Having these things in play before we trade and being prepared is what it's all about. So the technical side. So the majority of time, the markets move in a technical manner, trading between support and resistance. Yeah, we know that. Dow theory states that everything is known in the markets, so the markets are ebbing and flowing between support and resistance, supply and demand. Fine. Without intervention on the fundamental news, the markets would ebb and flow around the equilibrium at all times. But we know that's not to be the case. So the market to move directly has to first build its own momentum, and then nothing new would then affect the supply and demand. The markets would just trend normally. Again, it's a very nice example of a trend channel to the downside. When we finally break, momentum comes back into the market, yeah, and all the oscillators support. So that's just normal market action. You don't have to see, new information coming to the market for things to move technically. There's a whole section in my book that I'm just about to finish, and it's all about understanding that, what's the difference between a technical move and a fundamental. Well, a fundamental move, you won't get that retracement back to the 50%, or else it's not a fundamental, kind of technical scenario. But in a technical point, what you'll do is see the market break out, and where it breaks out, it will test again. So where the break point was, the market will come up, then come back down, and what was once support will then be resistance. Then you see a gradual move and an increase of the market trading technically. Whereas the fundamentals, you see these big long candles, very little retracement, then the overextension. So that's how you can tell if something's trading fundamentally or technically. It just fundamentally looks different. The charts look different. Okay, that looks nothing like the previous chart we saw. That's very ordered, very technical trading. Yeah, the other was just madness and lots of up candles. The market just pushed aggressively. This is much more structured, and that's how you know if a move is technical or fundamental. So again, as we see, we've got the support and resistance here. Again, very, very clear to see. We can see the sideways momentum. We can see the momentum building up in the RSI and building up in the D marker. Not much happening, ebbing and flowing. Bang, strength comes into the market. Technical buying comes out, just represented by the candles. Very, very small bodies. Then eventually the market then builds up that momentum, profit taking, big move up. Okay, so you follow the RSI, follow the D marker, and again, trade around the support and resistance. Just as simple as that. So again, when trading the markets, normal conditions, you have to allow time for these things to happen. If we've seen a consolidation period of all these candles, if these are hourly candles, then that's 4 or 5 days worth of trading. Okay, where the market has just found support along these levels, and then gradually, again, the Bollinger Bands have diverged, and then it's not until we have this break of the Bollinger Band here, and then close on the top of it, that the market, again, finds these targets, as where it wants to go to on the upside, these resistance points. So again, if it's taken 3, 4, 5 days, then you're going to have to wait a couple of days, or 4, 5, 6, 7, 8, 10 hourly candles for the market then to pick up that momentum and move up. It's not going to be like the fundamental news where we get it and the market does that and that in 2 candles. The market's going to take a lot longer because it's technical trading. Okay, so proved the market's gone on a downtrend, rejected these lower levels down here, found support, closed above the moving average, closed above the Bollinger Band, then bit of selling, tried to go up higher, bang, market then goes up and makes them highs. But that the distance of trading, from here to here, has to be fairly relative to here to here. Okay, so whatever happens here, if that's 50 candles for argument's sake, it's probably going to take 20 candles to reach the highs. So you've got to get in and stay in and be patient, because that's how you trade technically. It's not just going to happen off the back of that quick news and that everyone jumping into the same conclusion. Technical trading takes a lot longer to filter through. So really, in conclusion, my 80-20 rule is there for guidance. Don't ever fall into a pigeonhole that you're one type of trader or that you can't understand fundamental information. It is just as simple as understanding if it's good or bad for the economy, or good or bad for the sentiment of the market. If it's good, indices go up, bonds go down, golds go down. If it's bad, okay, stocks go down, indices go down, bonds go up, gold goes up. Simple as that. And remember, you can't simply fade out fundamental information, I don't believe. Okay, and be a successful intraday trader for any length of time, because you'll end up trading a fundamental move technically and you'll get so badly burnt, you'll know it's wrong. Okay, no excuses for not knowing when key fundamental data is or when speakers are made, because they're there for everybody to see. And remember, 80% of the time you're generally trading technically anyway, so the fundamentals just speed it up, and that's your bonus trade. Okay, when the data comes out and it's in your favor and you understand what's happening, that's your bonus trade. A balanced trader is always going to have a better handle on what the markets are likely to do, and you'll just be a better trader because you'll understand that you can't purely trade technically, that you have to understand the sentiment and understand what people are thinking. Remember, people trade markets and they're only human. All right, guys, that's my 80-20 rule. That's my take on why we should look at the markets this way. Has anyone got any thoughts, any questions, anything they'd like to ask? Again, hopefully that's fairly self-explanatory, giving you something to think about. No questions, guys. No thoughts. Okay, what do you think of the euro technically and also fundamentally post ECB? Yeah, very good question. Well, I think the euro technically, is finding a lot of strength based upon what Draghi said, and I think mainly we're seeing strength in the euro from the fact that this kind of win of all costs is not good. Okay, so the euro is going to start technically trading down. That's clear. We've seen a bit of spike in the euro today off the bad jobless, but the main reason why we've seen strength in the euro, not because people have got faith in it, because they don't have much faith in the US. The US is still the world currency, so big central banks, countries with massive reserves in dollars like China, Japan, are unwinding dollars and putting in reserves in dollars like China, Japan, are unwinding dollars and putting them into other so-called safe havens or more reliable currencies like the pound and the dollar, and the euro. So that's why we've seen strength in the euro. It's purely because of unwinding of dollar positions. It's not because people have faith in the euro. So the euro at some point is going to get back down, to probably see it at 1.2 by the end of the year. All this kind of quantitative easing might be introduced into the eurozone. Negative deposit rates, interest rates at 0.1 are not good. None of these things are good for a stable economy. So for me, all the short-term strength in the euro is going to be short-lived, and we're going to see the euro significantly down by the end of the year. So that's what I think exactly of that. But very good question. No worries, John. Always an absolute pleasure to see you. Yes, any thoughts on precious metals? Yeah, I've been quoted in the FT to say that gold's going to be at $1,000 by the end of the year. Seen a little bit of a bid going to gold, but you got to look at the bigger. Do a Fibonacci, right? Do a Fibonacci on the monthly chart of gold, and you tell me if it's going up or down. Yeah, it's going down. Once we break below, I think it's off the top of my head. What is it now? 1277 was my high point for the intraday, but once we break below 188, I think it is, then we're getting towards $100. The market's just going to go into free fall. So, massively bearish on gold, and I think it's definitely going to I think it's definitely going to be trading round about, not a million miles from $1,000 by the end of the year. I think that's what I personally think. Yeah, absolutely. 1.6, is a good level to go short at. Yeah, absolutely. I've got you 100% there, mate. That's a good level. That's what I've been looking at. And again, I'm just negative all the fundamentals and I'm negative all the technicals on the euro, and I'll never buy it. So I'm just a short seller on the euro. That's how I approach it. Good. Well, I'm glad you agree. That's what we're all here for. Okay, guys. Well, again, another good session. Thanks for your questions, and thanks for your Yeah, absolutely. Yeah, absolutely. I totally agree. Buy some euro equity and sell as a hedge. What I would say is just, keep your fundamentals close to your chest and have a good understanding, but always be very, very mindful of the technicals. Remember, 80% is still a massive chunk, isn't it? All right, guys. Well, hope you enjoyed that, and there's going to be a little break for a week because I'm off to Italy. I'm going to have a bit of a holiday and watch some football. So we'll catch up with you around about the 24th for the Trade for Life and Thursday as normal, and then we'll enter the new month and we'll have non-farm payrolls and the rest of the data as always. So absolute pleasure, guys. Again, help me however you can. Like on Facebook, forward tweets, all that kind of stuff. We need to get the numbers as high as we can, so I can keep doing these things. There's been a bit of a drop off in numbers, so refer friends. Help me in any way you can by spreading the good word, and that's we'll continue to have these good, enjoyable sessions. All right, guys, it's been an absolute pleasure, and I'll speak to you all very soon. Have a great night.